What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about the entire technical analysis on the Magnificent 7 companies. I'm going to give you an overview of the market technicals, go over market breadth. We're going to talk a little bit about percentage of stocks trading above or below their moving averages, the entire S&P and NASDAQ technical analysis as well. As always, if you enjoyed this video and find it helpful, make sure that you drop a like. I would really appreciate that. And the links to our Discord and our Patreon is going to be down below if you want to join. Of course, be a part of our MoneyVest community. You get access to over 46 members-only private videos, access to all the spreadsheets, including our trade alerts, trade ideas, buy and sell alerts, options alerts, all the Discord channels also included with the link down below. And also do connect with me on Instagram. My handle is going to be CASWRP. And I do post a lot of behind the scenes, a lot of the updates and tips and strategies and other stories regarding my personal life as well. So link's going to be down below. Would love to connect with you there as well. So first things first, let's start with our analysis on volatility. Now, for the longest time, we have talked about how the VIX is really important indicator for understanding the risk and reward. And when the VIX is high, it is time to indeed buy. And when the VIX is low, it is time to go. But I have kind of tweaked that message a little bit because it has been misinterpreted over the last couple months, because every time the VIX is low doesn't necessarily mean that it's time to sell and go. But if you are a long-term investor, it is time to start hedging and start de-risking and gathering cash once again, because when the VIX is low, the markets can continue to drift higher and the VIX can very well stay low. But when the VIX is indeed high, it is by far one of the best indicators to start dollar cost averaging back into the market and start putting cash to work, because when the VIX is high or it does spike, the markets do end up actually selling off. And right now we are seeing a little bit of a muted VIX, which does get up to 14, let's say 15 levels, but doesn't quite crack up to 18 or 20, or needless to say 36 or 40 levels, which of course we haven't seen in quite some time. Last time we saw that was back in November of 2022. And since then, we have not seen highs of about 18, we haven't seen highs of about 36 or 40, 18 to 24 we have seen in March of 23. And then once again, towards the end of last year, and so far 2024 has been a phenomenal year for the markets so far into 2024. So the moment it gets up to, let's say these levels, we're talking 36, 38, or even 18 to 20, this is going to be somewhat of a buy signal for myself, where I will be looking at dollar cost averaging back into the market a little bit more aggressively. You'll start turning the dial in terms of that cash deployment, and we'll start putting money to work. And if it gets up to 36 and 40, I mean, this is going to be about as clear of a buy signal as it gets, because the markets will obviously be down significantly if the VIX does end up, let's say, spiking up to 36 to 40 levels. I do apologize for all the noise in the background. I am in the metropolitan city of Kolkata, and there is, of course, going to be a lot of noise in the background, so I do apologize. Now, this right here is going to be crude oil prices. So we are seeing a lot of consolidation here in between that range. $66, $67 acting as a very strong area of support. We've kind of bounced off of that level very, very nicely, and resistance is going to be at 79, close to $81 per share for crude oil. And right now we're seeing a little bit of that resistance here at $79 to $80 a barrel. So this is pretty much a little bit of that range within which it's trading, with support levels staying put at $73, $74 a barrel, with a resistance up to $79 and $80 a barrel for crude oil as well. This right here, again, a little bit of a zoomed in chart of crude oil, and you'll notice that this right here is really the range within which it's been trading at the moment. $73 a barrel to as much as $79 and $80 a barrel at the moment as well. So if you are looking at, let's say, the spreads, so if you take a look at the 10-year yield versus the 2-year, we're looking at still negative numbers here for the yields. So right now you'll notice that we are a little bit negative, but as I mentioned before, a lot of the recession basically happens on the uninversion. So on the way up is when we actually witness the recession expectations kind of increase. So in the past, you'll notice back in 1980s, 1990s, and even as far as 1989 and 2000s, and then once again in 07, 08, right before the great financial crisis, and then once again in 2019 and 2020, every single time we've seen the spread turn negative. So in other words, the yield curve basically inverted and then on the way back up. So when it was uninverting is when we actually witnessed a recession over in the US. So right now we are seeing a little bit of that uninversion. but it hasn't fully happened yet because the spreads are still negative. They're still negative 44 basis points at the moment. Something to keep a close eye on because it, again, is a very important technical indicator for the economy and for the US in terms of recession as well. Now, when it comes to the market breadth, now this is one of the most important indicators that we look at when we are trying to understand market technicals. And what you'll notice is that every time it kind of gets up to that red rectangle, that's what the markets are very, very overbought, meaning that majority of stocks in the S&P 500 are trading above their 20-day moving averages. And what that simply means is that majority of stocks are overbought, technically speaking. And every time you get up to that level, it is no surprise that a pullback is coming, a correction is coming, and this time was no different because we did witness this entire sell-off. But of course, the markets are getting bought back up, and we are pushing right back up to 71, 72%, meaning that 70% of stocks are trading back above their 20-day moving average, and only 30% are trading below their 20-day moving average. So if you do see that market participation come back in, there is a probability that, once again, we get up to that red rectangle, that red area, which is that 90% plus range, plus area. And of course, that could lead to more potential downside and a little bit of reversal back down for a potential pullback from the market. Now, this right here is percentage of S&P 500 stocks trading back above their 200 simple moving average, so 200-day SMA. So again, the RSI is a good indicator on the broader level to look at on the S&P, but this is, again, the market breadth. And as soon as we get up to that red rectangle, which is a 90+% range, then a pullback or a correction is coming. And right now we are, once again, kind of hovering around that 72, 73% range. We have gotten up to like about 72, 73, 80%, and we have pulled back every single time. But if we do get up to, let's say, this red rectangle again, 90% plus range, then of course a pullback is eventually going to happen. It's not a question of if it's going to happen. It's a question of when it's going to happen, because as we already understand, markets cannot keep going up forever. Everything moves in cycles. If markets are doing well, eventually they will come down. If they're going down, eventually they will go back up. So that's exactly the technicals and how the markets function. Now, this right here is percentage of stocks trading above their 200 SMA. So on an entire market, not the S&P, not the NASDAQ, but the entire market. And this right here are the ranges within which we're looking at. And again, right now we're at 65%, not quite at the highs of 90s. But of course, if it does get up to over 85, 90% levels inside this red rectangle, that's when we will start to become a little bit more cautious once again and not really be looking at dollar cost averaging back into the market just as of yet. This right here is the S&P 500, so you can see a very nice consistent uptrend of higher highs and higher lows. And what you'll notice is the RSI, of course, very, very overbought, trading about over 75 on the weekly time frame, with the MACD also pushing higher very, very nicely. And the price itself continues to trade at an all-time high as it continues to drift higher and higher. Just got to be super careful because we have seen, very, very significant streaks with 12, 18 weeks of consistent greens, with just a few weeks here and there that have been red. And the markets, so even on the weekly time frame, are incredibly overbought at over 75 RSI. So can the markets keep trading higher? Yes. Can we continue to trade at an all-time high? Yes. Can the markets, disregard all valuations and market technicals and keep pushing up? Yes. But that's not the idea. The idea here is to understand the risk and the reward. What do you think? What was the better risk and reward trade-off when the markets were here at around 4,200 or when the markets are here at 5,100? What was a better risk reward trade-off to dollar cost average into the market and start going long? When the RSI was low over here in the 40s and the MACD was also pretty much red and down, and the markets were basically selling off here and they were trading as low as 4,200. Like, what was a better deal is what I'm asking you. Was it back then, or what is it right now when the markets are at 5,100 with an overbought RSI, overbought MACD? Of course, the answer is 4,200. That was a better deal. That was a better risk-reward trade-off for the market. And that's exactly the idea, right? We're trying to understand the risk and the reward for the market. We're trying to understand those dynamics, those technical dynamics that are going to be way more important for the market than to simply understand, okay, momentum's in the favor, let's start going long. Things don't work that easily. It's always an understanding of the risk and the reward here. Same thing with the NASDAQ. We've seen a very nice consistent rally of consistent weeks pushing higher, drifting new all-time highs. RSI at well over 70. MACD also been pushing higher. Apple stock over here trading within that lower high and lower low range with a very strong support sitting in the $180 all the way down to $160 per share for Apple. So those right there are going to be a couple of support levels to watch for Apple at the moment. And of course, we're trading within this context of this lower high and lower low, resistance up to 190 to as much as $190 per share. Apple RSI trading at 40. MACD also been really low. So we are trading at somewhat reasonable to low technical readings here, with of course the price action as I already mentioned, lower highs and lower lows. Amazon here coming up to its resistance of 176, so that's the level to watch. If you do get a breakout above this, then the next level is going to be closer to $190. Support level at 155 down to $143 per share for Amazon. So those right there are a couple support levels, resistance up to 175 to $190 moving forward. Now this right here is a Tesla stock, as we already know in the weekly time frame, lower highs and lower lows. Support level is going to stay put at close to $180 with the resistance back up to almost as much as $240. We do have a little bit of resistance to keep in mind over here. That's inside this red rectangle that we're kind of struggling to break out of at the moment, but very clear chart. Technicals are super weak for Tesla, considering that it's still within the context of this lower high and lower low at the moment. And this right here is going to be that support at close to $180 per share for Tesla. NVIDIA here continues to trade higher and higher to new all-time highs. So on the weekly time frame, we've got 6 to 8 weeks of consistent rallies. Of course, the RSI MACD very overbought. It's been well over 74, 75. MACD's also been trading higher. With new record highs, valuations almost getting up to $2 trillion. So the message is very clear, very simple. Got to be super careful, super safe and cautious with this stock because of how much momentum it has. And of course, the valuation getting a little bit up there with expectations being so high. So for me, NVIDIA, of course, in the low 500s makes a lot more sense than trading at almost $800 per share. Advanced Micro Devices also in a very similar boat. This right here is the higher highs and higher lows and continuing that uptrend here very nicely, trading almost pretty much at an all-time high here, coming up to that resistance of $180, $185. So this right here is the resistance to keep in mind between 180 and 185. A little bit of that negative divergence that's also following through for AMD. So this right here, lower highs for Advanced Micro Devices with a horizontal resistance. MACD has also been selling off below the signal line. A little bit of consolidation here between that range. Very strong support in the 160s, a very strong resistance in the 180s for AMD and versus been consolidating sideways in that range. Meta here breaking out to new all-time highs, yet still getting rejected in the 490s, 488, 490s here for Meta. And 451, 450 is going to be that support, a little bit of that gap that needs to be filled. And the support all the way down to 383, down to $352 per share for Meta moving forward. So that right there is, again, going to be a lot of consolidation. Support levels going to be down in 350s and 380s for Meta moving forward. Talking a little bit about Google here. So Google just lost some consolidation sideways in that range between 140 and 144. Resistance all the way up to $150, $151 for Google as well. And just a lot of consolidation all the way down to 126, down to $117. This right here is a pure buy zone for me personally. It's going to be a no-brainer buy for Google, where I'll be picking up a lot more shares for this stock at closer to 117, low 100s. And I think Google and Meta, not really Meta, but Google is actually one of the stocks that is fairly priced at the moment among Magnificent 7 and big tech stocks. Microsoft, on the other hand, continues to trade within the context of this uptrend, so higher highs and higher lows. Resistance is going to stay put at close to 421 with a support level at close to $384, $385 per share, and just a lot of momentum to the upside for Microsoft at the moment. So very nice consistent move up of higher highs and higher lows, but technical support level is going to be 384 down to 366, resistance up to 421 for this company. So hope you all enjoyed this video and a complete update on the Magnificent 7 and technology stocks here. Make sure that you drop a like, and of course don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos. The 16% annual discount that's available until the end of this month. You do get access to our moneyvest.com platform that's going to be launching very soon. I'm super excited to share that with all of you, and as always, happy investing. I'll see you all in the next video.